Hi, I'm Jason Kosec, President, CEO, and Director of Integra Resources. Integra Resources is an precious metals development company focusing on near-surface heap leachable ounces in the Great Basin.
Right. Jason, good to meet you. We had a great session with you previously, I think back in May. Was excited about what you guys said then, and certainly from a technical perspective. But we can talk a little bit more about the commercial components. You put a PEA out, maiden PEA for Wildcat, Mountain View. Numbers look good. The market seems to be pleased. Are you?
Yeah, I'm very pleased. You know, we kind of guided the street in the 250 to 275 range. So we always purposely sandbag numbers. So we underpromise and overdeliver. So coming in at, 310 million after tax NPV US, 37% IRR, an all-in sustaining cost of 973, initial capex of 115. So your capex to NPV ratio is 2.7. Industry average is about 1.3, 1.5. So, the teams did an amazing job, and we're very, very pleased with the outcome.
Yeah, and I guess it's nice because you've kind of seen some of the inflationary pressures come off. I know George, was quite brave and kind of put out an economic study in the height of the COVID supply chain, etc. And the market perhaps was like a little bit like, whoa. So do you expect to see some of these costs are dropping off as you kind of move through the phases? Do you think there's more gains to be had?
Yeah, I think some of the costs are coming off. Not a lot, but explosives and cyanide have come off, pulled back a little bit. But the big thing is 30% of your OPEX is fuel, right? Yeah. So fuel has to come down a little bit, but we offset it by using rail fares and stuff like that, and natural gas and that sort of thing.
Right. Okay. And obviously you've used $1,700 gold, so you got a little bit of margin to be had and captured there too. Look, well done with PA, and I guess you've been out telling the world about it, and we will do a little summary at the end for people. I want to focus on the kind of commerciality of the business, right? So you've done some really good things recently. Obviously, the coming together of the two companies, the kind of consolidation of the shares, you've got a strong share register, that's for sure. It looks good from the outside, but there's a lot of moving parts. Anyone coming new to this just wants to understand, I guess, the mentality and the goals of the team. So we're talking about Wildcat and Mountain View today in Nevada, but you've got the Idaho projects as well, advanced economics as well. You've got tailings to be captured. You've got lots of ways that you can affect the economics of what you're trying to do here. But how are you prioritizing where you spend your money that you raised back in May? Why is that the smartest allocation of capital now? And I guess we'll kind of rumble into what the future looks like. So how are you prioritizing the assets and which ones you go after first?
Yeah, so what we do from a 30,000 foot view, okay, is we're in the business of risk mitigation. People think it's about finding ounces and drilling ounces. That's the easy part. Minimizing risk and getting a permit as fast as humanly possible is what we're in the business of. Because people forget the time value of money to a record of decision is the most important thing. So we take ounces that are valued at 0.1. We add ounces in a systematic, scientific manner, and we bring them to 0.9 or 1 times NAV when we build it or when it's acquired. Okay. How we prioritize things, one of the biggest things that we're doing this year in Idaho, obviously, is submitting the mine plan. That is basically a feasibility study to the government. It is our flagship project because it's the furthest advanced, obviously, and getting the permit as fast as humanly possible is priority number one always. And, to get there, there's a lot of de-risking you have to do. There's a lot of baseline, a lot of stakeholder engagement that people don't really talk about, but frankly costs a lot of money. And a lot of companies don't do that. In Nevada, it's the same thing, but a little bit more focused on exploration. Okay, we put out this PEA because we strongly believe of being radically transparent and showing robust economics right out of the gate, so that when you start doing your big drill outs, your major showstoppers have been removed. Your MET, your geotech, your conversion rates, your fundamental controls, mineralization. So as you step out and grow the resource base, people can update their DCF. You know,
so again, I just want to I'm going to sort of jump in every now and again because I want to make sure I totally understand this. So obviously, Delamar significantly advanced, and you've explained what you've got left to do. That there's a time component to that, obviously. In that, permits take a bit of time in Idaho, 2 to 3 years, I think you indicated in the last conversation. Anything changing your mind on that time frame?
No, I think the team has done an amazing job, and obviously George is fully focused on delivering that. So he's down there pretty much once a month, working, having the opportunity to work with the local tribes, local community in Boise, and obviously starting to do a lot more lobbying in Washington. And all seems very, very promising. So I think that 2-3 year timeline that we've been guiding is real.
Right. Okay. And again, one of the another kind of strategy move was the absolute focus on oxides. It's less capex. You can get at it quicker. It's a simpler process, and margins are pretty good. So to that end, is that something that has been done in Idaho? Is that going to be a problem?
No, Perpetual they should have their permits by the end of the year is what they're guiding. So projects are getting permitted. Where we are, it's a little bit different of a landscape than where they are. They're fly fishing streams and beautiful mountains and trees and all that sort of stuff. And southern Idaho, it looks a lot like Nevada, and it's pretty much an arid desert. And Delamar's a historical mining town, right, from the 1900s onward. So, I don't see any issues because it's been a mining town since really the turn of the century.
Right. Okay. And again, just coming back to this kind of prioritization of time. So George is kind of doing what he can do up there in Idaho. It will take some time. If we look at what you were doing down in Nevada, and obviously this main PEA, we've got a sense of the scale of adventure that you're going for. The company is targeting 200,000 ounce. It wants to be a 200,000 ounce a year producer. So you're ambitious, that's for sure.
Well, right now we are the largest gold and silver resource endowment in the Great Basin that's not owned by a major mining company, right? We're sitting at just over 6.5 million ounces globally, of which 4 million ounces are leachable. And that number will grow well over 7 million ounces and close to just over 4.5 million ounces leachable. So yeah, it is ambitious, but we have a very robust resource base to provide that production profile.
With the different projects at the moment, the economic study phases at the moment, how far do you intend to take this? Because clearly you're surrounded by some pretty big players in there in the Great Basin. They've already got operations there. You're going to soon be able to kind of start demonstrating the economics that it may be achievable. Are you going all the way with this one? I can't quite remember what your positioning was, and maybe because they're coming together, you've got a different view.
Yeah, it's in our technical and financial capacity to build these. Okay. That being said, as George and I are the largest individual shareholders, selling the company is open for the right price. Remember, permitted ounces, Matt, in the basin go for on a PNAV consensus basis 0.89. We're trading at 0.1. So if someone gives us 0.9, go ahead, you can have them. If someone kind of lowballs us, no, we'll continue to push it on ourselves, because we're in the business of making money for our shareholders and frankly for ourselves as well.
The fact you kind of got these layers of options with regards to assets at the moment, did it make it easier to raise money in May? Did that story of that kind of combined narrative sell it a bit more than perhaps working individually?
Yeah, people forget too is that by doing this merger, you save over $2.5 million US in G&A a year. Frankly, there's too many companies out there and not enough people to manage them and run them. So by combining the two entities, what it did is really create that go-to vehicle for the institutional space to remain relative, for the retail space, and kind of any major corporates that want access and NAV exposure to the best mining jurisdiction in the world. So, a long-winded way to answer your question, yes, it made us easier to raise money for a number of reasons, right?
It's kind of interesting. That's a conversation that we're hearing a lot. The first conference, we just came back from Quebec and also down at Barcelona. And I think that in moments like this, in markets like this, management teams who've kind of been there and done it before, built projects out before, and we've spoken to George previously about him and his team, it is imperative that companies who can demonstrate that they will versus the companies who are need the momentum, need the promote to kind of just move the story along a little bit further in the hope that the market believes them. Someone might come in and take the pressure off them to actually do it, or the thing falls over. So in terms of the way that you're talking to the market, talking obviously to the new money coming in, talking to what is quite a good list of current strategic and institutional investors, you're trying to project, or you will be projecting, the ability to get this through to production yourselves. Yeah.
Oh, 100%. Yeah. Having partners like Wheaton Precious Metals as one of our largest shareholders and BD Capital, what that does is not only is it significant project validation, because those guys rip through both companies' data rooms, you better believe it, before they write checks. But what it also does is it removes project financing risk. We always want people involved and looking 3 years, 5 years down the road, and getting people involved now to get comfortable with that. And those are going to be our partners, right, for project financing.
Yeah, no, it's true. I was with Randy Smallwood yesterday in London. He had good words to say about what you're doing there, so that's always nice. Right. So if we look at let's look forward. Let's look forward to what your shareholders and anyone new to this story will be looking at in terms of that kind of phasing. What are you going to be delivering for the rest of this year? And what you need to be hitting out of the park next year?
Yeah, so the big thing that is coming, in September this year is the stockpiles for Delamar. You're looking at about 60 million tons, okay, that sits in those stockpiles. Kinross, if it wasn't above 0.85, it went into the stockpiles, okay? The current oxide component of the PFS at Delamar that gives about 314 million of NAV is modeling 81 million tons. So you can understand the impact that those stockpiles will have, okay? So stockpile resource update in September. Then we will submit the mine plan of operations for Delamar. We will just kick off the real exploration program at Wildcat. So you'll see a lot of news flow coming from the drill bit. That's one of the reasons why the two assets really complement each other, is because Delamar goes into this permitting phase. Mountain View and Wildcat go through this nice, exciting exploration euphoria phase. And now that the PEA is out, every time you step out, the market can update their DCF, and every 10% growth is an extra $50 million in after-tax free cash flow. So resource update, mine plan, exploration, and then at the end of next year, a feasibility for Delamar.
Right, and I guess at today's prices, you're also delivering a 51% IRR on Wildcat, Mountain View.
On a combined basis, for the whole company, just look at what we deliver as one company. At spot prices, it's just over $875 million of U.S. NAV. Okay? Let's not talk about all the exploration growth. Let's not talk about the stockpiles. So right now, you're about just over $1 billion Canadian of NAV. Commonly, developers trade at 0.5, 0.7 in premium jurisdictions. That's a $500 million company. We're $90 million. So there's a lot of value creation over the next 12 to 24 months that's going to be ongoing. And it's going to be a really fun ride.
Yes. So okay. So you obviously at 90 million, no one wants to sell out at that, and your peer analysis is spot on. It's like ours. You are not getting the value that others are. But do you think the things that you're doing will start to get reaction? Obviously, the equities market has been really, really difficult. Gold's at a good place. Gold price is at a good place. Where do you think that kind of moment's going to come from? Is there any one thing, or is it just good, solid, old-fashioned, steady, accretive growth?
Matt, all it is we tell our team, let's put our heads down, let's get dirty in the trenches and deliver on everything we say we're going to do. And those major catalysts of doing the PEA, kicking it off, the resource, the mine plan, the feasibility, and showing growth, when you execute all of those, the market will give you value. And it'll just be slow, steady. But at the end of the day, for permanent ounces in the Great Basin, on a PNAV consensus basis, they go for 0.89. So it'll be slow and steady as we check the boxes of everything that we're doing.
Because I've been talking about all these peers, but there's some pretty big companies, there's some pretty big resources out there. Are you going to be able to compete on scale and grade and margin with those guys?
Yeah, Matt, I think the robustness of this PEA is shows it itself. One of the things that people probably didn't understand in that is, and why companies do PEAs really is so they can use the inferred resources. But one thing people forgot in the release is that 80% of the resource that feeds the PEA is actually indicated. So, growing this thing and stepping it up to a feasibility at the next stage is completely doable because most of the resource is already in that indicated category.
Well, that's it for me. I just want to kind of catch up about the process. So in terms of the kind of the technical work that you're doing, I think we like what we heard last time round. Obviously, permitting and baseline type stuff is ongoing, and community work is important. Jason, I appreciate your time today. We will be following this one very, very keenly. So appreciate it. We will see you soon and let us know how you get on, okay?
Thanks a lot, and thanks for your listeners for tuning in today. Much appreciated.